It's 2 a.m. A house just sold, not toured, not inspected, not even seen in person. The buyer offered $80,000 over asking, waived every safeguard, and still feels like they got lucky. Now here's the part no one wants to say out loud. That same house might be worth less next year. So, what exactly is going on? Because depending on who you ask, the housing market is either still booming, about to crash, or somehow both at the same time. And that contradiction, that's the story. Let's rewind. For years, housing followed a fairly predictable rhythm. Interest rates go down, people borrow more, prices go up. Rates go up, borrowing slows, prices cool, simple. Then 2020 happened. Suddenly, money became extremely cheap. Mortgage rates dropped to historic lows 3%, 2.7%. At one point, and even lower. That changed everything. Because when borrowing gets cheaper, people don't think, great, I'll save money. They think, I can afford more house. And millions of people did exactly that. At the same time, something else happened quietly in the background. Supply disappeared. Construction slowed. Supply chains broke. Workers left. Projects got delayed. So now you have more buyers, chasing fewer homes. Prices didn't just rise, they launched. In some areas, 20% in a single year. In others, even more. Homes became auctions. People weren't buying houses anymore. They were competing for survival. But here's where things get weird, because the story should have ended there. Rates go back up, demand falls, prices drop. That's how it's supposed to work. Except that's not what happened, at least not fully. Interest rates started climbing fast, from under 3% to over 7%. In financial terms, that's not a shift. That's a shock. Monthly payments doubled for new buyers. Same house, same price, completely different reality. So demand should have collapsed. And technically, it did. Fewer buyers entered the market. Applications dropped. Sales slowed. But prices? They didn't crash the way everyone expected. In many places, they barely moved. In some, they kept rising, which makes no sense until you see the other half of the equation. The people who already own homes, millions of them, locked in ultra-low mortgage rates during that 2020 to 2021 window. 2.5%, 3%, maybe 3.2%. Now imagine you're one of them. You have a comfortable payment, a house you like, and a mortgage rate you will probably never see again in your lifetime. Would you sell to buy another house at double the interest rate? Most people won't, and they aren't. This is what economists call the lock-in effect. But in real life, it's simpler. People are stuck, in a good way. They don't want to move, so they don't list. And when people don't list, inventory shrinks again. So now we're in this strange situation. Demand is weaker, but supply is even weaker, which keeps prices strangely elevated. It's like a market that wants to correct, but physically can't. And then there's a third layer, investors. Over the past decade, housing stopped being just shelter. It became an asset class. Large firms started buying single-family homes, turning them into rentals, bundling them into portfolios, and when prices dip even slightly, they step in, not emotionally, not impulsively, mathematically. To them, a house isn't a home, it's a yield. So every time the market softens, there's a quiet floor underneath it, not always visible, but very real. Now let's talk about affordability, because this is where the tension peaks. Prices are high, rates are high, which means monthly payments are extremely high. In many cities, buying a home now costs significantly more per month than renting the same place. That's not normal. Historically, owning tends to become cheaper over time. Right now, it's the opposite. And yet, people are still buying. Why? Because of something that doesn't show up in spreadsheets. Expectation. A lot of buyers believe that if they don't buy now, they'll be priced out forever. It's not just a financial decision, it's psychological, a fear of missing the last exit. But here's the uncomfortable math. For prices to keep rising at the same pace, incomes would also need to rise dramatically. They haven't, not even close. So something has to give. Either prices fall, or incomes catch up, or the market just freezes. And that last option, it's already happening. Sales volume has dropped sharply, not because people don't want homes, but because fewer transactions make sense. Buyers hesitate, sellers hesitate, everyone waits, and waiting slows everything down. It's not a crash. It's friction. Now zoom out, because this isn't just about houses. Housing touches everything: consumer spending, bank stability, construction jobs, wealth perception. When home prices rise, people feel richer. They spend more. When prices stall or fall, that feeling disappears, even if nothing else changes, and that shift in behavior can ripple across the entire economy. There's also a generational angle. For older homeowners, rising prices have been a massive wealth boost. For younger buyers, it's a wall. The entry point keeps moving further away. Saving for a down payment now takes years longer than it did before, and every year prices don't fall meaningfully. That gap widens, quietly, relentlessly. And then there's one more twist. Everyone is watching interest rates, because rates control everything here. If they fall, monthly payments drop, demand surges again, prices could spike even higher. But if rates stay high, the freeze continues, and over time, pressure builds, because life doesn't pause forever. People get new jobs, have kids, get divorced, relocate. Eventually they have to move, and when enough of those moments stack up, supply returns, not suddenly, but gradually, and that's when the balance can shift. So where does that leave us? In a market that feels broken, prices too high, payments too high, activity too low, a system where people who own homes don't want to sell, people who want homes can't afford to buy, and the usual mechanisms that fix this imbalance aren't working the way they used to. Which brings us back to the original question. What just happened to the housing market? Nothing simple. It didn't crash. It didn't stabilize. It transformed into something slower, tighter, more fragile, and harder to predict. Because the next phase doesn't depend on just one thing, not just rates, not just supply, not just demand. It depends on how all of them collide at the same time, and when they do, the result probably won't look like the last cycle or the one before that. So here's the real question. If housing is no longer behaving like a normal market, then what exactly is it becoming? And more importantly, who gets left out when it finally decides to move again? Now here's where things turn from confusing to slightly absurd, because in a normal market, high prices fix themselves. They attract builders, developers step in, new homes get constructed, supply increases, prices ease. That's the release valve. Except this time, that valve is partially blocked. Builders are dealing with higher borrowing costs too. Labor is still tight. Materials are still expensive. Permits take forever in many cities. So even when builders want to build more, they can't scale fast enough to matter. And when they do build, they're not building starter homes. They're building higher margin properties, bigger houses, more expensive finishes, higher price tags, because that's what makes financial sense for them. So the very thing that's supposed to make housing more affordable often ends up just the opposite. And then there's policy. Governments know housing is a problem. They talk about it constantly. Affordability, access, first-time buyers. But meaningful change? That's slower. zoning laws, local resistance, political trade-offs. Everyone agrees housing should be more affordable, just not necessarily in their neighborhood, so supply remains constrained, not just by economics, but by design. Now add one more layer, rent. Because while buying has become harder, renting hasn't exactly become easier. In many places, rents surged alongside home prices, which creates a strange trap. If you rent, say you feel like you're falling behind. If you buy, you might be stretching too far. Either way, it feels like losing. And that emotional pressure, it keeps people in the game longer than they probably should be. Let's pause for a second and look at the numbers in a different way. Imagine two buyers. One bought a home in 2021, low price, ultra low interest rate. Another buys today, higher price, much higher interest rate. Even if the price difference isn't massive, the monthly payment gap can be enormous, hundreds, sometimes thousands more per month, for essentially the same asset, same walls, same roof, completely different financial reality. That gap is creating a silent divide, not just between owners and non-owners, but between owners themselves. And over time, that divide compounds. The first buyer builds equity faster, has more flexibility, can weather downturns more easily. The second buyer, they're more exposed, more sensitive to rate changes, more dependent on stable income, less room for error. So even inside the housing market, risk isn't evenly distributed anymore. Now here's the irony. For years, people were told, don't try to time the market, just get in. Real estate always goes up. And for a long time, that felt true. But today, timing suddenly matters again, because the cost of being wrong is higher, much higher. If you buy at a high price with a high rate, and something shifts, rates stay high, prices soften, or your situation changes, you don't have the same cushion previous buyers had. Oh, you're locked in, but not comfortably. And yet, sitting on the sidelines isn't easy either, because if rates drop even slightly, competition can return instantly. Buyers rush back in, bidding wars restart, prices jump. So waiting has its own risk. You're betting on a future that might not arrive the way you expect. This is what makes the current market so difficult to read. Every path forward has trade-offs. Every decision carries uncertainty. And the old rules, they're not completely gone, but they're not reliable either. So instead of a clear direction, we get tension. A market pulled in opposite directions at the same time. High rates pulling demand down. Low supply pushing prices up. Investors stabilizing declines. Affordability squeezing buyers. A policy moving slowly in the background. It's not one force driving the market. It's a standoff. And standoffs don't last forever. Eventually, something breaks the balance. It could be rates dropping sharply. It could be a wave of new supply. It could be economic pressure forcing more people to sell, or something unexpected entirely. Because markets like this, they don't resolve neatly. They snap. But here's the uncomfortable part. By the time it's obvious which direction things are going, the opportunity is usually already gone. That's how housing works. Slow, until it isn't. So we're left in this moment, where everything feels unstable, but nothing is collapsing, where people are waiting, but quietly preparing, where the biggest decision most people will ever make has never felt more uncertain. And maybe that's the real story. Not that the housing market is broken, but that it's changing faster than people can adapt to it. Because if this is the new normal, higher costs, tighter supply, slower movement, then the question isn't just, is now a good time to buy? It's something much bigger. What does affordable housing even mean anymore in a system where affordability keeps moving out of reach?